Hi, welcome everybody. We'll just be getting started in just a few minutes. Hang in there. Depending on what time zone you are, if you're in the Pacific time zone, you can have your lunch. It's a great time to have lunch and watch.
Company then, right?
Oh, that's good. Yeah. And
All right, I will share my screen here and then we will be good to go.
All right, good. Well, again, welcome everybody to our webinar. We're pleased you could join us today. We're committed to doing constant education for our clients and everybody out there who's on this webinar, and this is our monthly webinar. Today we're going to talk about the market update and tax planning, and I know there's a lot of interest in that with the change in government and what does that mean for our portfolios and the investment climate in general. And we hope to cover that. And if we don't cover all of it, feel free to ask us questions afterwards or connect with us. And then also the idea of planning for taxes every year, that's a good idea. So we'll talk about that as well. All right. Now, 2021, this is what we're going to do today, the 2021, a little update on our team. And then Jason, our vice president, will do the market update. And then Julia, our CEO and founder, will do the tax planning reminders. And by the way, my name is Chandran Rajaratnam. People also call me CR I have no idea why. Anyway, they call me CR, that's fine. And we'll look forward to talking to you. So I'm the president, Julia's founder and CEO, and Jason, our vice president. Julia started this business 20 years ago. And I guess her passion has always been to help people with their financial lives and making sure that people were utilizing their money properly and planning for retirement as well. So, let's go the other way. All right, so we founded in 2000. And so we're a comprehensive wealth management firm, and we're committed to helping our clients improve their success and pursue financial freedom. That's the name of our company. This part of the slide that says who we serve, just one of the key things I want to say is that we serve everybody. We have no minimums. We're one of the few organizations in this industry. We have no minimums. We got young 20-year-olds just started their first job. If they're smart enough to start a Roth IRA with their first earnings, we're happy to help them because that's the right thing to do, and we get people started very early in their lives. But over time, we noticed that we're the Dave Ramsey SmartVestor Pro. We've been doing that for 12 years now. It used to be called Endorsed Local Provider. Now it's a SmartVestor Pro. And so we have a lot of Dave Ramsey enthusiasts as clients and people that deal with us. If you don't know, Dave Ramsey is a syndicated radio programs. He's got syndicated programs, does podcasts, and he's got some great ideas on how to, in a very simple way, take care of your financial life, get out of debt, plan for retirement, plan for your kids' education, et cetera. And we're sure happy to help all the people that follow down that philosophy. But basically, our business is about retirees, business owners, and people who want to invest. One of our key niches that seem to have grown is that early on, Julia was helping widows that were in transition. They just lost their spouse and did not know what to do with their money, how to take care of their retirement, all of the complexities of that. And so over time, that seemed to be referrals got us more and more people going through that transition. In the past, it's getting a little bit better now, but typically it was the male of the house that handled the money. And then if that male passed, the female partner did not have any idea of how to take care of that. So we do a lot of women in transition. I would change that to people in transition because I also have a widower as a client that we helped get through his tough situation that he had. So, but the net of it is a whole whole wide range of people in our society. Now, last time I looked, there was about 330,000 financial advisors in the country. I dare say that half of them might do a pretty good job investing money. Not as good as us, of course, but let's say half of them could. But very few of them are, as I said before, have no minimums, and very few of them would put the position out like we do, which is our commitment is to care deeply about you and your financial life. And our focus is to create a plan for your dreams, and more importantly, to inspire you to achieve financial freedom. And inspiration is the key because that allows people to use their creativity as well to make the plans necessary. And one final aspect I want to share with you is that we have a set of values that we're willing to go out of business before we compromise it. And that is we're going to treat all people with respect. We do not care who it is. If they need help with their finances and their financial life, we'll be happy to help them. Never compromise their integrity. And the key word is never. Delight our clients. We need you to be delighted. Not only is that just a good way to be for us, but more importantly, there's even an ulterior motive because it's been said that satisfied clients will stay with you, but delighted clients will tell other people. So if you're out there, if you're a client watching this and you're delighted, don't forget to tell other people about us. And one key item for our company is that we embrace our team culture. And I'll talk about that, our team, in a second. So these are a list of our services, investment management, retirement income distribution, family wealth. You get to the point where you're retired, your house is paid off, you have enough money, and you're going to be leaving something to the next generation. There are some key factors to make sure we leave it to the next generation and not to the IRS. There are lots of things to take care of before that happens. We do a lot of educational events. As I mentioned, we do monthly webinars. Our key is that an educated client, as educated as you want to get to, we're happy to help because that really helps our partnership with you. And always make sure that we pay the appropriate amount of taxes and not a penny more. And there are lots of ways that people sometimes do overpay because they have not taken advantage of the programs that are available, and we can help with that. And then for small businesses, we do services such as 401ks and help people with their exit strategies and things like that. So if you're a small business, come to us as well on our website, financialfreedomwmg.com. You'll take a look at what's called the Freedom Business Builder, our programs to do that as well. So the idea being a comprehensive service, wealth services. We have 7 physical locations, and we're pleased to announce that our new location in Massachusetts, in Winchester, Massachusetts, especially with the COVID, stay-at-home orders for the last year, we've been mostly Zoom and phone call, even in Oregon and Washington. But as you can see on the next slide, we're pleased that we have over customers in over 37 states. So Zoom and all those electronic devices allow us to have a good connection with that as well. I don't know why we haven't got any clients in North and South Dakota. It's probably too cold. I think maybe in the springtime or summertime, we may be able to, if you're in North or South Dakota, please call us. We really could use. So we want to fill this map up all the way. Hawaii is another place we really do have to open a branch there, especially in the winter. And Alaska is the beautiful mountains out there. So over time we will. But we're pleased, we're honored to be able to serve people in all across the country. And the people who serve, so here we are, this is our team. 18 of us at this point. One key item is that we have 7 wealth advisors, but we're all a team. So if, let's assume David, we call him DJ. DJ is your wealth advisor. We assign people a lead wealth advisor to work with our clients. But if David's at a conference and the client calls in, David's client calls in, anybody can answer the question. We are a team with one collective wisdom as far as our portfolios are concerned. And so anybody can take care of that as well. And then our support staff, our 12 11 support staff that's on this chart can answer all the questions, take care of all the devices. Don't forget, all of us are committed to delighting you, the client. So, and then we're pleased that recently we've added 3 new team members. Gabby, as Client Service Associate out of our Salem office, Shauna, a Client Service Associate of our Newport office, and Catherine, our Wealth Advisor in Massachusetts. So welcome all, and they're all here to serve our clients, or serve you as well. And with no further ado, let me bring on Jason Harris, our Vice President. Jason lives in a town called Corvallis. Now, for those of you not in Oregon, there are 2 main universities in Oregon: the University of Oregon in Eugene, whose team is called the Ducks, and then Oregon State University in Corvallis, and the team's called I don't know, what are the teams called?
Beavers, of course.
Oh, Jason on the Beavers, right? So, in spite of the fact that Jason supports the Beavers, he's a really good guy. So, let me pass it on to Jason. Jason, take it away.
Thank you, Chandran. I appreciate you continuing the rivalry. Yeah, what a wild ride 2020 was, especially in terms of the markets, of course, also in our lives. It's been pretty crazy. We actually saw the deepest recession of our lifetimes. We saw a 35% drop in US stocks. So when we were looking at some of those statements, there was a little bit of shock, sticker shock, I guess it would be. So yeah, that was the end of March last year. So it was not that long ago. Businesses were closed. You guys remember that? The streets, the highways were nearly barren. I mean, it was absolutely crazy. And we had this new virus without a vaccine, almost without hope. And but then as the year kind of went on, and looking at the stock market, and I know the overall economy, jobs haven't quite fully come back, and there's a lot still left to do, even though we do have that vaccine in a couple different forms. But yeah, market-wise, we closed the year with some crazy statistics. I was looking at the Dow Jones; it was up almost 10%, and that's your top 30 companies in the U.S. Our large U.S. companies, which is the S&P 500, it was up a little over 18%. That's a really good return, right? Tech companies, that's the NASDAQ, those were up over 48% last year when you're looking at the full calendar year. Not just from when things, got bad at that low point. No, this is for the whole calendar year. International stocks were up over 10%. Emerging markets, which is a part of international stocks, those were up 18%. Even bonds were, some were as high as 9% return. So we saw some really great things come out of a really terrible and tragic situation. And by the way, we had an election during all that time. Don't worry, I've got some of that baked into here that we'll talk about. But great results, even after riding through some very scary times. So now we have another challenge that is presented to us with Congress. And I know you guys have been tracking this. You were looking at January 5th and what's going to happen and the outcome of all that. So we can look at the next slide here. So it's not quite a blue wave. So I know we've kind of talked about, okay, what if the president is Democrat and then both the House and Senate are majority Democrat? What's going to happen? So we're close there, but the Senate is actually a 50-50 split. So now, of course, the tiebreaker does go to the Democratic vice president, which will be Kamala Harris. By the way, that Harris, that sounds good, doesn't it? I think that's a good last name. So anyway, but so you see there is more towards a split Congress, but towards a Democratic Congress, but there is a little element of that split Congress because of that Senate situation. So, but look at these returns. So this is showing average annual returns for large US companies for the past 70 years, when it's a Democratic Congress, so let's just pretend that it is, right? Because it kind of leans that way, a 10.7% average return on your large US companies for looking towards the next year. So that's not too bad, right? I mean, I would take that. Now, these aren't guaranteed. This is just averages. Averages are in the middle of something, right? And then if we kind of lean towards, okay, well, it's kind of like a split Congress, you're looking at 17%. So even though, because I know there were lots of fears and concerns that, okay, if there is too much control in Congress from Democrats, we're going to get a zero return, we're going to get negative returns. But that's not what our history shows us. And you can see that pretty clear on this chart. With Congress being set up the way it is now, and with Joe Biden stepping into the presidency, we will likely see more stimulus into the economy. So we've already seen some with the one end of last year, right? Everyone, not everyone, but a number of people got the $600 checks dropped into their bank account. So that happened. And what we've noticed is that stocks really like that stimulus because it's infusing capital into the economy and really trying to, almost like a heart, what are those things that kind of revive the person? That's what this stimulus is intended to do. So the markets like that. We'll likely see another $1 to $2 trillion this year pumped into our system. That'll be to help businesses kind of get back on their feet. It'll be to help individuals that are still hurting from COVID. And it will also be to help disseminate the COVID vaccine and get all of that. We're trying to get back on track, aren't we, as a country? And so this COVID thing has really just kind of dampered everything down. So you'll see that infusion of capital with the Congress like this. So with this, we're also not likely to see an increase in taxes this year for 2021. There's just so much still unsettled. There's still the COVID. It would not be a good time for Congress to institute a tax increase. But by golly, it's got to be coming because we've spent already about $4 trillion on this COVID relief, and it looks like it'll be closer to 6 by the time all is said and done. So we can look at the next slide here. So did you guys know that we just went through a recession? I mean, that's what happened this past year. It seems odd because it was kind of weird and we didn't really know what was going on and we're so consumed by COVID, but that was an actual recession. And now it was one of the shortest that we've ever seen, and it was also the deepest that we've ever seen. And so looking at this chart, this one shows the average, okay, wait, before I get there, I want to talk about the average recession length. So the number of years for an average recession is 1.3 years, so 15 months basically. Now, obviously, this one was much, much shorter. So we've done that, we've checked that off our box, and now we go into expansion. So it's economic expansion is after recession. Average of an expansion is 5.3 years. So that's good. That means this is our track to run to for growth and to see things rebound, to see jobs come back, to see the economy come back, businesses rebound, new innovations happen. This is kind of the strain in which that happens. Now, the last one we saw was 2008. And then right after that, you can see on this chart, the far bar to the right, July of 2009 is when we started the expansion, and that lasted almost 11 years. So once we got to kind of that average, maybe about 6 years, everyone's asking, okay, is it gonna happen? Is it gonna happen? And then it was finally almost 11 years later that COVID hit and we saw this recession. So how long will this next expansion last? We don't know. I mean, you see some of the lowest one there is 1 year. But it's likely to last a little bit of time. So that's what our hope is. before we see another recession. But it's good to just kind of look at it and know that, okay, since we have gone through the recession, now we do have that trajectory to be able to grow and see our companies and things rebound. Okay, then the last slide we'll go over here. I'm going to bring it right back to the elections and all that stuff because I know it's top of mind for a lot of folks. But we looked back over over the 93-year history here of large U.S. companies and looking at non-election years. So this doesn't care about president who's in or not, but on a non-election year. So every year that has an odd number in it, like 21, average return. Look at that, 14.3%. Now, again, this is not a guarantee of what you're going to get in large US companies, but when you look back, these are the best times are in non-election years, possibly because there's not so much craziness going on. I don't know. There's just something maybe settling about, okay, we're done with the election and now we get to focus on something else. So what this tells us is that this is a time to not abandon our strategy and do something crazy, but to make little tweaks. And that's what we're doing inside our clients' portfolios. Is as we see changes and shifts of what's coming up, we are making those shifts. But it's not going to be a huge, like, throw out the baby in the bathwater, but it's like, let's stay our course and make sure that you're set up for your future. And that's going to look different for different people. We've had a lot of folks that have transitioned in their life, either retired or changed jobs, lots of that going on. So you may need to make some tweaks that make sense for where you're at. But when you look at the stocks and look at the markets, this is a positive thing. And we don't have reason to be concerned or be panicked about that. So with that, I'll pass it over. Julia, anything else for this piece?
Yes, thank you, Jason. That was really informative, and really appreciate some of those charts. I liked seeing the data.
Yeah.
Because sometimes our emotions get disconnected from what's happening in the stock market, and we get this feedback a lot from clients that you know, no matter either side on your, you know, how you believe politically, but you know, we've heard a lot of concerns about what's going to happen with the market moving forward, and I think these charts should really bring us all to calm.
Yeah.
And know that there is a lot of momentum happening in these markets. And I'm not sure where the quote's from, but there's a quote that says, "Don't fight the Fed." And so if the Fed is putting money into our economy, into you know, sending payments to Americans, we need to go with that. So that's why they're initially here. There's not a lot of tweaks and adjustments that need to be made. But I do want to say our investment committee meeting is meeting here extra these weekly here in January, and we are looking at all of our positions, and we will be making those tweaks into the portfolios in the weeks to come.
Yeah.
That we see fit. Yeah. So let's move on here and let's talk about tax 2021 tax reminders. We don't know a lot of tax updates, but I will talk about where maybe we are going in the future with taxes. Jason talked about not only the stimulus that we've gotten in 2020, but also what's coming most likely in 2021. But how are we going to pay for these stimulus packages? Any ideas? You can put it in the chat. It helps us now consider it a bridge, right? So we're getting a bridge to the other side of this pandemic. But on the other side of this pandemic, most likely there will be higher taxes. Most likely there will be inflation, you know, things that are coming down the road that we are looking at to make sure that your portfolios can benefit from those coming things. So then the new stimulus package that was voted in right before the end of the year gave $600 direct payments to adults and dependent children. So if you've gotten your $600 payment, like put it in the chat, say yes. We have heard a lot of clients have been receiving those already. So that's great. And then if you were receiving unemployment benefits, there was an additional $300 a week in benefits extended through mid-March in a couple months here. They also approved $325 billion in small business aid. So helping those businesses that were the most impacted due to COVID. So restaurants, gyms, movie theaters, the travel and hospitality industry. And what I liked about this new stimulus bill in regards to small business funding is you have to qualify for it. You have to show that your income has been drastically reduced. So it was more of a really centered effort to really get the aid to the people that needed it the most, that's been devastated by this. Let's see, we said yes, a lot of yes, they've got the payments, so that's great. So here we go into tax season. So as of right now, we have until April 15th to file our 2020 taxes. And these are the current tax rates. So if you, there it is, starts at the bottom there at 10% and goes all the way up. 37% is the largest or the biggest tax percentage tax bracket. And then on the sides, whether you're single or married, you can follow that up and find where your taxable income is. And that will tell you what tax rate and what tax bracket you're paying. So this is based on federal rates. The other part of taxes for 2020 is the standard deduction. So again, these are a lot higher than they used to be. Most Americans now will take the standard deduction as opposed to itemizing deductions. And so for a married filing jointly couple, it's $24,800. And then I also want to say, if you are 65 or older, you will get an additional $1,300 for each spouse that's 65 or older. Let's see, we have a question. We will come back to some of these questions at the end. So we will come back to it. Unless it pertains to what we're talking about right now, and feel free to put questions in the chat as we go along. Okay, so capital gains rate. So the capital gains taxes come into play when you sell an asset and realize a gain. So this could be investment real estate, it could be individual stocks, any type of property that or real asset that you're selling. So if you are in there is a 0 capital gains rate. So if you are in the 10 or 12% tax bracket, so married filing jointly up to about 80,000 of taxable income, you can sell a stock or sell a mutual fund or an investment. And if you, as long as you stay under that 80,000, you would not pay capital gains tax or any tax on that sale. If you go into the 15% bracket, which is for everyone that is not in that 37% tax bracket. So we should have had these slides side by side because then we can see. But if you're not in the highest tax bracket, then most likely you're going to be paying 15% in capital gains on the anything. So if your income is over 80,000, oh, there it is right there. So if 80,000 up to 496,000. So if you fall in that range, you're paying 15% taxes. And then if your income, your taxable income is over 496,000, then you would be paying 20% on capital gains. So where President-elect Biden has talked about the proposals for increased taxes is in the capital gains area and in the top tax bracket area. So what he has proposed is that if you have capital gains greater than $1 million in a given year, so we have clients that sell businesses, and so it's easy to get over $1 million in gains, or investment real estate. Well, that rate, that 20% would go to 39.6%. So almost a doubling of tax on anything over $1 million, which would essentially, I think, make a lot of people pause to think, do I want to sell my business and lose 40% to federal tax and then state tax on top of that? As of right now, it's only 20%. So that could be a change that's coming. The other thing that is a proposal is that there is something called a step up that you get in your cost basis. So at deaths. So I'm just gonna, for an example here, my grandmother just recently passed away, and she had stocks that were owned by her and my grandpa for years and years and years, and they had made quite a bit of gain in those stocks. So if she were to gift those stocks or sell those stocks in their lifetime while they were still living, then they would have to pay taxes on the gain. So if they bought it at $10 a share and they sold it at $100 a share, then they would pay taxes on that $90 per share. Now, if they never sold it, and then the next generation, so my parents, inherited that asset, they would get the value of the date of death. So the $100 a share. And so if they turned around and sold that, there would be no taxes due. So what they're talking about, the proposal, is that that cost basis does not get stepped up at death, or maybe gets stepped up, but it would only be to $1 million. And then anything over $1 million would have to be realized as capital gains. So that impacts, in our client base, we would understand that impacts a lot of us. So it's important that we keep an eye on this and understand and do some planning if needs to be for once we know, right? We can't make any plans until we know for sure, but this is one thing that we're looking at that may come down in the years to come. Okay, do we have another question? Let me see if it's. Okay, so the question we have was, does the Biden plan look to capital gains and 401ks to pay for the current stimulus? I'm not sure about 401ks, but definitely for the capital gains is one of his big areas that he's looking that creates more tax dollars. And we need more tax dollars, frankly. There's no way that we can go through spending 4 trillion, 5 trillion of money and then not be able to pay for that. So we are going to have to pay for it. It's just how that shakes out down the road. Yes, good question. Yeah. Okay, so we want to encourage you to keep funding your retirement. Our emotions, again, sometimes get the best of us when the markets go down so much, like we saw in March. We tend to want to stop investing. And then we say, oh, I'll invest more when the markets comes back. But stop and pause and understand that, no, you don't want to invest when the market's up. You want to invest when the market's down. But when do we know when it's up? That's the other side of that coin, right? It's a double-edged sword. Because now that we're at all-time highs, we have people thinking, oh, I don't know if it's a good time to invest now because it's so high. Here's the deal. We never know. We never get to know what the future holds. And it does not the way that we predict it, even the best economists and the best money managers out there, it's really hard to predict what this market will do, as we, I think, seen in the last 6 weeks with how much it's come up. So I would encourage you, if you're not yet retired, to keep funding your retirement. That's something that you'll hear from our whole team. Understand if a Roth IRA or a regular IRA contributions are better for your situation. And again, it goes back to understanding what tax bracket that you're in. So if you are in the 10 or the 12%, the bottom 2 tax brackets, most likely we're going to guide you to put your money in a Roth IRA. Where if you're in a higher tax bracket, then we're going to guide you to maybe do a little bit of both, or more where you're going to get a tax deduction for putting that money aside for your future. Also 401ks, retirement plans, 403bs, employer sponsored plans and IRAs are excellent statutory tax shelters that we can use. But after we just talked about, taxes most likely will go up in the future. So if you're thinking that way, understanding the power of the Roth, where that will grow tax-free for you, is critical, because they're not going to deduct taxes from that in the future. So if you can take advantage of that, I would say that that's definitely something that you should do. Also remember that you can contribute to your 2020 IRA up until April 15th of this year, so we can put money in for 2020 still. So really take advantage of that. And that's a good reminder. Okay, and then these are the current defined contribution plan limits from you can see the 2020 column and how it's increased in 2021. So really only in the defined contribution. So this is the 401ks, retirement plans, those have gone up $1,000 each. Okay, so as of right now, if you are over 72, then you will have to do a required minimum distribution for 2021. Now, I know a lot of our clients did not take one in 2020. It was kind of like a free pass that the Fed gave us so we didn't have to take that money out of our retirement accounts, which was great. But we have not heard otherwise this year. So those required minimum distributions will need to start up again sometime this year. And one unique thing that we really want to raise awareness around is something called a qualified charitable distribution. So you can do this anytime after the age of 70.5, and it applies to your retirement account. And what you can do is you can take money out of your IRA or your retirement account, and you can gift it directly to your favorite nonprofit, your charity of choice. And if you do this, it does not hit your tax return. So a lot of us that are taking the standard deduction, we're not able to deduct the nonprofit contributions. So what this allows you to do is take it right off the top. And so you're not paying taxes on that money from your IRA. So you can do this up to $100,000 a year. So if you don't want to increase taxable income, and you do have a charitable heart and you're giving, this is a good thing to consider, taking that from your IRA. I'm going to pause there and look at a question. Well, you guys have good questions, but I'm going to leave those for the end, but I promise we will come back to those and get all your questions answered. Okay, and again, we have not heard that the individual tax returns deadline has been extended this year. So for 2020, that deadline is the April 15th. You can file an extension all the way up to October 15th. And then also a reminder that first quarter estimated tax payments are due, by April 15th as well. And then, like I said, the IRA contribution deadline is April 15th. Okay, so let's finish this up and then we'll come back to some fun questions that you guys have. All right, so if you're new to Financial Freedom Wealth Management Group, then we want to introduce our process to you and also to our clients as a reminder. So typically we call it the Financial Freedom Advantage. And most of our clients come to us through an educational encounter, much like this. We're talking about, all things markets and taxes, and just really want our clients and friends to be informed about all things financial. And then if you decide to go to the next step, then we would like to offer a comprehensive discovery with one of our wealth advisors. And this is a process where we like to say it's fun, right? But it is where we really discover what's important to you and identify your needs and goals, and reveal what do you need to do to realize your full potential in your future. And then we follow that up with what's called our tailored solution, where we teach and deliver unique solutions designed to empower you to reach your financial goals. And these are unique to you with all of the concerns and the needs that you brought up in the comprehensive discovery. We kind of deliver that and talk about that in the tailored solution. And then our guided journey, where is a relationship together, where we're continuing to care deeply about you and your financial life, and kind of doing this financial journey with you and reviewing and just ongoing learning how we can get you to those financial goals. So it's been really rewarding to see people retire, to send kids to college, to pay for a whole trip for your whole family, back when we could travel, of course. But it's really rewarding to do that journey with our clients. Okay, so if you are new to us and you would like to schedule a complimentary consultation, you can get out your cell phones and text the word freedom to 458-777-4458. And our team will actually, you'll get a link to our calendar where you can schedule an appointment with us, or if you need other help, we can help you there. If you want a kind of a tax guide that goes over a lot of what I talked about, we actually did mail this to our clients in December, so you should have it if you're a client. But if you don't have it handy, or if you want it again, then please text the word tax to that same phone number, and we will make sure to get you our 2020 tax guide as well. We are partnered and kind of our broker dealer is LPL Financial. They are the largest independent broker dealer. We have been working and aligned with them for 12 years now. They are they do provide SIPC, so it's called a Securities Investors Protection Corporation, which is if LPL or if that business were to fail, your money would be protected. And then all of our advisors, our securities registrations and our licenses are held with LPL Financial. Okay, and here's some small print. So if you have a question, you feel free to put it in the Q&A or the chat box, and we'll get through this here. And I think I'm going to leave the screen. I'm going to go back to the number so you guys will have that as we go through some Q&A. Okay, so one question we have here is it better to put in our retirement account or finish paying off our house if you're close to retirement? Great question. So what we would want to understand is your retirement on track? So are you saving at least 15% of your gross family income into your retirement account? And I would say if you're close to retiring, we also want to know, are you on track to retire? Because it maybe needs to be more. But we would recommend doing retirement before paying off your house, because you can't get back the time. You know, a lot of us are like, okay, I want to pay off the house. I want to be debt free, but you don't want to be debt free and no retirement. So, because the house, your primary residence is essentially, you know, it's providing residence for you, but it's not creating income. It's kind of a dead asset in that way. It may appreciate over time, but you're not getting income from it, and it won't help you retire. It'll save in your expenses. So we do like our clients to get debt free, and hopefully that is mortgage free, but you know, in retirement, but it may not happen right away. So hopefully that answers your questions. The next question, I'm going to put these two together here. What kind of companies would you recommend to invest in? And then would you advise to invest in mutual funds, stocks, or bonds? All right, so we are going to have a really good conversation around that. So we do not recommend investing in single stocks. So that is a recipe for disaster. You can just lose too much of your nest egg if you have everything in one stock. And so we definitely recommend either mutual funds, we use ETFs, and then bonds. You can have a bond mutual fund or a bond ETF. So depending on your risk profile, we would provide a mix that would be best suited to where you are in the stages of life. So Jason, do you want to add anything to that?
Yeah, just the, you mentioned ETFs. So those are exchange traded funds, very similar to mutual funds. And we do utilize both of those. But yeah, that diversification is really critical. And having a wide assortment, like a lot of times people are like, oh, I don't want to do international stocks. But you know, as we've seen, they do bounce back. So things will be in different positions in terms of their returns over the year. So it's good to have multiple things working for you. But yeah, it is very critical that we know your situation to help really guide how much stocks versus bonds versus other investments.
Yeah. All right, and then this next question is my investment in real estate. So this could be medical buildings, strip malls, has not seemed to do very well. When given the opportunity, should I move my money out of these into something else? Oh, so one of the kind of extremely hit areas in the COVID that has not yet recovered is commercial real estate, because no one's out and about, right? No one is, we haven't really fully opened up the country yet. And so, but that is something that that they will return as we get this vaccine distributed across the nation. These are the things that will be late to the game in this recovery, right? They will come back. I would argue maybe office space in New York or San Francisco may not come, may take a while, because I think we're going to see a shift in that and how we do business, where we can more work comfortably at home, and some of those big companies may not take that stake in the office space. But what I know you're talking about is the medical buildings, more of the strip malls that do have anchored stores that are more grocery stores. That will all that will come back. So it will take time. I would say the opportunity to move out it into something else, you know, if we had the glass ball, you know, we could see of course how this all would have been best played out and what investments you would have. But again, that's why we have everything diverse, and hopefully something's doing really well when something else is not doing so well. And then it could be real estate real estate will really benefit when we have inflation. And although we say we may not have inflation for 2 or 3 years because the Fed says we're not going to raise rates, but we're already seeing inflation. There is more demand for products out there. So with inflation, real estate and investments like this will bode well. So it may take a couple years, but you can see how it will cycle like it always does. All right, another question. Biden has said one of the things he intends to do right away is increase federal minimum wage to $15 an hour. This obviously will place a heavy burden on many small businesses. Do you anticipate this will have a negative impact on the market? Okay, I have a lot of personal opinions about that as a small business, but it's these small businesses that would be impacted by this is the mom and pop restaurant, the really small micro businesses in all of our communities that we care and love for, not what we're investing in. So although it's tragic that it would even put more pressure to put those businesses out of business, which there's so many, most businesses are those kind of businesses. So my hope is that there'd be representative enough across the country that there wouldn't be a huge increase in that right away, but I'm not sure. But it's not going to impact the stock market. The stock market are big publicly traded companies that we're investing in. So there's a disconnect there, and that's what's sad about this is there's already a disconnect in our society of you have more of the people that invest and they have assets, and then you have the poverty and the lower income. And so this could create more of a divide there, which is not good for the country. Do you have any thoughts on that, Jason or Chandran?
Yeah, I was just going to say, well, many times when they raise the minimum rate, it's stepped in over time. Rarely do they do a single big bump, to 15. They'll have different times, like the different cities have done that, like Seattle and places like that, over a period of time.
Yeah.
So you won't have that.
Yeah. What would impact stock as the stocks is if corporate taxes, which is again in the proposals of Biden, is if corporate tax rates go back up, that would be impacted in the stock market. Can I do a 401k or a IRA to offset tax debt? So yes, by contributing into a 401k or a traditional, you need to make sure it's a traditional IRA, you will get a tax deduction in the year that you do that. So if you do it now for 2020, you could still offset taxes owed in 2020. Now it's not dollar for dollar. It's about 25 to 30% is what, so if you owed $10,000, then you and you put $10,000 into an IRA, it's only going to knock off $3,000 on that tax debt. Okay, so it's not dollar for dollar.
And another thing with that too is if you are contributing to a 401k, you usually can't get a tax deduction on the traditional IRA. It'll be tax deferred, but not the discount on your taxes.
Good catch. Yes, thank you, Jason. Okay, how is the real estate market look in the next couple of years? That would just be kind of our best guess. Again, if we have inflation, if we start seeing that real assets like real estate does well. Now, if you have an office building in Manhattan, that would look probably very different than your own residential real estate. So, yeah. I have an indexed annuity. Do you have those too? So we do work in that space, although I have to say that it's a more conservative investment. So you want to make sure if you are you a conservative investor? Should you be in a conservative investor? And so there's usually purpose behind that type of investment. So it's not for everyone, it's very specific. So we'd want to make sure that that would be the best investment for you.
And a lot of times if you're not working with someone currently, we can help manage that for you as well as part of your overall plan.
Yeah, good. Okay, can you sell individual stocks? So again, as a rule of thumb, we do not use individual stock investments. I think a question back to Chandran, when Seattle raised the minimum pay, a lot of small businesses still went out of business. That's just the feedback.
Yeah,
So
no, correct. It's just that it again happened over a period of time, so it doesn't have an immediate impact, but it is that balance between providing people living wages and also making sure those micro businesses can make it all work. And
yeah, and I think some people kind of like throw in the flag when they start seeing tax increases, or even if we get wind that capital gains will be increasing. I think in 2021, you're going to see a lot of activity to either sell those positions, unwind, decide to retire in anticipation of higher taxes in the future. So it's not only that they're out of business because they can't afford it, but they also kind of give up in a sense, like, I don't want to deal with these kind of headwinds, and I'm going to go do something else, which is really unfortunate because America was built on small business, and it's important to all of our communities. All right, so one more question here. You guys have lots of questions today. Good job.
Great.
So by real estate doing well, do you mean our homes will appreciate in value with inflation? Yes, typically that's what happens with higher inflation. Yes. But if you make more, then also that means if you move to the new destination, you're going to be paying more for the home too. Yeah. All right, I think we got them all answered. So any parting thoughts?
Julia, one of the questions about real estate, the healthcare, was specific to a couple of alternative investments, and there was a question there. And our answer is we're looking at that. We're waiting for those investments to get to a liquidation point, and we'll make a decision whether we should stay in those or not. Those are at the right time. So as long as they're still paying dividends, their actual value doesn't look as good, but the actual performance of dividend paying is still consistent. So it's doing what it was supposed to do. It's just artificially, it doesn't look that good from a value point of view. It's like if you had 4 rental houses and you're still getting the rent, but the actual value of the rental houses are temporarily depressed. It looks like you have lower value of assets, but yet you're still getting the rent. You just hold on to it until the right time to sell those houses, if that's what you want to do.
Yeah. Patience. Investing is a lot about patience. Yeah. We say it's a marathon, not a sprint. Yeah.
That's right.
All right, everyone. Well, thank you for tuning in today. And we've got a packed 2021 webinar schedule for you all, but we're always open to ideas. So if you want us to talk about a specific subject, please email that into us, and we would be happy to add that into the schedule. All right. Thanks, everyone.
Everybody be safe, be healthy, take care.
Bye.
Bye.
Bye.